Hey everybody, this is George with Bentley Properties, and yeah, I guess we were a little blurry there. Anyway, that goes with the day today because today was crazy. So not only did we have a lot of showings today, we had a number of homes that we ended up writing offers on through the week, and every single one of them was multiple offers. And that's what today is about, is to kind of give everybody a perspective that, hey, look at February, mid-February is when our spring market starts to really kind of get out of first gear and starts heading into second and third gear. And well, with some of the other newer cars, you might even hit sixth gear. But nonetheless, interest rates actually came down into the high fives. It was brief, and we expect that to happen actually a couple of more times. With that, the buyers are definitely out, and there's a ton of activity. When from about mid-October, we really started drawing down that inventory. And it is super important to understand that as we start looking at inventory coming back down again, interest rates starting to come back down, even though they bobbled down, then they went back up again, that people are starting to realize this is the new normal, the new market, or I guess really kind of to say, we're getting back to where we used to be in a balanced, healthy market, albeit our inventory is now dropping for residential below the 2-month window, which is kind of important. Now, with that, let's go ahead and take a look at some of our information here. So first, remember to subscribe, share, and like, because this is the #1 news channel. There's no selling. It's just going to give you some really great information like this. So on market, we have 734 new homes coming on market. Now, remember, last week we actually had closer to about 600, and this number is going to continue to inch up. And in fact, we should start looking at, as we get into March, start looking at about 1,800 homes, 2,000 homes coming on market. Same thing with our pendant. Here you can clearly see for every home that's coming on market, 2 are leaving the market. So we're still pulling down that inventory. And the key is that we need to actually start having more sellers, come on market. And they will. And that's super important to understand, because if we start pulling down to the 10 days of inventory, 7 days of inventory, like what we had at this same time last year, nobody wins. And of course, then, the multiple offers then start to get a little crazy. All right. So with that, here we go again. So again, each week we look at the same metrics, and it is single family only. Somebody did ask that. So I wanted to make sure, listen, we do single family only. It is the consistent metric that we measure. Condos, manufactured home, vacant land, they skew the numbers. And so let's just keep it real. And besides, you like real, and it's in real time, which is really the best part, because it allows you guys to make the best business decision when the time is right. It's the whole goal. All right. So as you can see, we've got some highlighted sections where we've got some numbers that are really impressive. So when we take a look at January versus February, at least up to this point, you can see that our pendants are up 74%. Well, you take a small number and you make it, double it. It makes a big number, or, half it again. But we're right on target with where we need to be. We're not really off the chart. However, when you take a look at the year-to-date sales and year-to-date pended, you can see that our pended are only 5.7% off. Sales are 29% off, almost 30%. You might say, George, holy smokes, dude, that's a big number. No, it's not. It's not, because the last year interest rates were at 3.8, 3.2, 3.5. We're at 6.3% right now. We're double the interest rate. But here's what's super interesting. We are catching that number. And in fact, when you take a look at the number of active homes, okay? So if I come back here and you take a look at the top yellow line on the right there, you can see that our inventory is actually now only 124% of where it was last year. And you might say, well, George, still, that's more than double. Well, holy smokes, last year we had 3,100 homes. That is nothing. We should have 11, 12, 14,000 homes on market right now, and we don't have that. We're at, 7,000. But what's super interesting is that as we start looking at next month in March, and especially in April, if we looked at our 700, we'd actually be down below where we needed to be, even compared to last year. And last year was horrifically low, because by that time we should have been in the 18 to 22,000 homes at any one time. When we take a look at new construction, again, it's the same thing. You can see that our numbers are absolutely pulling down. We're seeing a lot more pended. Buyers are definitely out there in the market. Builders are, even though there was a surge of homes that came on, which is normal, it's going to taper off, okay? Builders are going to start pulling back. Not so much a supply chain issue. It's the cost of getting that home ready. In fact, you're going to see a lot of plats starting to sit for a while until they can work through some of the standing inventory before they engage, because, just the cost. It's cheaper just to hold it than it is to actually start pushing things through and then have too much inventory. Now, even though our market is doing really well, and yes, there are still some indicators between the 10-year treasury and the 2-year treasury that is a little bit inverted. It's a little unique when we talk about maintaining, what we call affordable mortgage interest rates versus, going some crazy sky high level. But as we start looking at that and some of the economic metrics, we got to make sure that we maintain that balance. Otherwise, it might get a little ugly. Bentley Properties. It's super funny when you take a look at that bottom left-hand corner. There's a go. We had one REO in January. We had 12 in February. And then, of course, that gave like 1,100% or whatever that number is. Some insane number. Again, it's inconsistent. Just remember, our REO inventory is super low. Okay, it's almost negligible. All right, because this is half of Washington State, a little bit more than half of Washington State, and we're only talking about, what the heck is it, 27, 37 homes, that's really small. That's one for each one of the demographic areas. Small. Anyway, we are, again, one of the 5 cities, and we're in the 5 areas, I should say, in the sweet spot where banks come in. If it actually comes back, then it is actually pink carpet and vinyl, and they get it back on the market, and they get it market value. There are very, very few really good deals for bank-owned properties out there. I'm just saying. All right, mortgages. When we take a look at this, hey, look at that. We're at 6.12. It's actually 6.3, I think, is where we capped out. Technically, at the end, it came in right after we did this video. And there's been a ton of conversations. We've had a lot of conversations with different clients and different folks just asking questions as to what is going to be happening with rates. Look, rates go up and down every single day, every hour. And in fact, on Feb 2, we were in the 5s. Now hang on. We weren't there very long. And in fact, Shavi, when we were talking today, she's like, I saw that. And I'm like, I know. And it was brief. It'll happen again. So the mortgage rates, they're bobbling, okay? And depending on how things turn out. So they went back up again, not because the Feds did their quarter 25 basis points, right? Quarter of a rate. That's lending. That's HELOCs, home equity line of credits. That's the car loans. That's your credit cards, things like that. What banks lend to each other daily. Now, they do have an effect, right? You need to watch the 10-year treasury. You need to watch the bonds. You need to watch the mortgage-backed securities. Those are the things that will show you trend, and that will give you the indicators of what mortgage rates do. Super important to watch, because as you are looking at making your purchase, because there was, I don't know if they still exist, or a few lenders out there that were offering like a 3-month lock today, but you had to close in 3 months. I don't think those are going yet right now. They might be, not really sure. I have not heard that exists. However, you need to watch that because you may want to float. If we've got some reporting that's coming in, whether it's the labor or cost of foods index, or a unemployment index, that will have an effect on what the mortgage rates do, and they could very well dip down with some good news. Mortgage rates will drop. You want to lock in, or you may just want to say, you know what, I don't want to take the risk. I'm going to just lock it in now, which I totally get. It amounts to, well, hundreds of dollars every single month. But get a load of this. Still lower than a year ago, purchase mortgage applications rose 3% and refis were up 18%. I'm surprised we have refis. Most of the time it's cash out refis. But this is the most important one that is super, super important because we were talking about folks doing a 2-1 buy down. We've had Dan Golden in here talking about mortgage rates and doing a 2-1 buy down, until the mortgage interest rates come down, which we are expecting. But it says Black Knight reports 57%. 57%. That is a massive number, okay? 57% of recent borrowers access lower rates with permanent rate buy downs. Nearly 25% paid 2 or more points. 1 point is a percent. So 2% or more. So 25% of the 57% actually bought down the rate more than 2%. That is a big deal because we're not just talking about, $100. We're not even talking $1,000. We're talking about tens of thousands of dollars, $17,000, $20,000, $25,000, $18,000 to buy a rate down. If you're buying rate down at 30-year money, you better hope you're going to be in that property a long time because it's going to take a long time to make that pencil to justify the expense. If you need more information, we can chat about that. Just let me know. Housing inventory fell by 8,664 units last week. All right. What's important about that is as we start limiting inventory, that means that, basically if you have, 500 people and you've got 5 cans of soup, that 5 cans of soup can only go so many directions, right? Well, 5 to be exact, just for those math geniuses. Anyway, that means that we're going to start getting into the crazy, escalations and multiple offers. Right now, we have multiple offers, but nothing's crazy. Everything's been, humane. That could very well change if we start dropping our inventory down into the 1 month range because we're just right at that 2 month range, just under it. If it drops down, it is going to be crazy insane, and I pity the soul that's out there trying to buy a house again. Sorry. All right. Mortgage rates hit their bottom. I did a highlight for those of you that did not believe me. There it is, 5.979. That's the one that I caught at that point. Super cool. And it's going to happen again. Remember, interest rates bobble all the time. And as you can see, that chart, they're up, they're down, they're up, they're down, because it is a publicly traded thing. They're not established. There isn't somebody behind a desk going, I think I'm going to charge this today. It's not it. It's publicly traded. Just like the stock market goes up and down. So you need to watch it. And it can change from hour to hour. Be mindful of that. All right. In the meantime, if you have any questions, reach out to us. We love questions. Like, share, and subscribe. Okay. The benefit to like, share, and subscribe is you get this information as it comes out in real time. We're doing this twice a week as people requested. We like to do what people ask. And this way it allows you the ability to get in, get what you need information-wise to make that best business decision. Again, there's no selling here. It's just good, solid information. In the meantime, you have an absolutely beautiful day. I'll see you on the next video. Take care.